Hello and welcome to your daily game sizzle with me, Jon Jordan. Today I'm taking a deep look at the fundamentals of the three big US games companies floated on the Nasdaq, which is Activision Blizzard, EA and Take-Two. And in particular, what I'm looking to do is to try and connect those companies' share price rises over the last 5 years with changes in the fundamentals of the companies. So let's start off by looking at the share prices of those three companies. So in this graph here, going back to 2007, I've plotted the yearly rise or fall in share prices for the three companies. So if we take a look at the graph, we can see EA is in blue, we can see Activision Blizzard in red and Take-Two in yellow. And I guess the most important thing to see is from the years 2007 to 2012, it's kind of a volatile picture. It's kind of up and down. So in 2007, say Activision Blizzard, we see a big jump, so over 50%. Its share price goes up in the year, but then 2008, obviously a lot of things happened in 2008. Significant drop in share price. Recovers 2009, 10, 11. Generally, those companies are seeing positive change in their share price. 2012, all of them see a fall in share price over the year, but coming to the kind of present, over the last 5 years, we see every year those three companies have all seen their share price rise, and for a significant amount of time, they've seen very big rises in share price. So if we look at EA, it's over 50% in 2013, over 100% in 2014. Not so good since then, but still, quite large share price rises. Activision Blizzard, 2013 over 50%, 2015 getting on to 100%, and 2017 almost 70% last year. And then Take-Two, again positive, over 50% in 2013 and 14. And in 2017, it was actually over 120%. Its share price went up, which was the largest rise for any kind of large-scale games company during the year. So, last 5 years, the kind of conclusion is these three companies have seen a very significant increase in their share price. So now our task is to go and find out why that has happened. So our first exhibit in the search for evidence is to look at this graph. So this graph shows the three companies' trailing 12 months bookings. So bookings are the raw sales that the companies make every quarter. So this isn't GAAP revenue, which has all this kind of complications with deferred revenue and how companies defer certain types of revenue. This is the pure data. So bookings, and then trailing 12 months basically brings together 4 quarters in every point, so as if every quarter was the end of a financial year. So you get a good, smooth, in most cases, idea of where this number is going. So what can we see here? I've rebased this, as we can see, so we're looking back over 4 years. So rebase it so they all start at 100, effectively 100%, back in Q4 of 2013. So again, obviously same color scheme. We'll take Take-Two first. So we look at Take-Two. So Take-Two, actually, we can see over this period of time, its bookings, so effectively we're saying its sales here, have declined over the last 4 years. So that's surprising. We've seen its share price has shot up, particularly last year. But its bookings, its sales have declined. Why is this the case? Well, in the case of Take-Two, there is a kind of an issue, an artifact really, in that GTA 5, its biggest game of recent years, was released in the end of 2013. So you kind of have this artifact that had a very big game that was released then. That doesn't really matter though. We can still see that what we're looking to do is tie this back to share price. So one thing we might expect share prices to go up if sales are going up. In this case, for Take-Two, sales haven't gone up at all, and certainly haven't gone up anything like as significantly as its share price. Let's have a look at EA, so the blue line. So we can see with EA, the bookings, the sales have gone up over this period of time. Kind of that's what you'd expect for most companies. They've not gone up particularly significantly, so they've gone up maybe 20% over this period. That's positive, but again doesn't really account for the share price change. So with Activision Blizzard, remember that's the red line, so we can see here that's actually has gone up, but a very tiny amount, 8% over the 4-year period. But what I've done here is in 2016, Activision Blizzard made a very significant acquisition. So it spent almost $5.9 billion, almost $6 billion buying King, which is a mobile games company who makes the Candy Crush game. So I put in the pink line here, which shows the impact of effectively buying King. So if you strip out King, you have the red line. So that's just the bookings from Activision and Blizzard. They don't go up very much at all. Obviously, if you add in King, I mean, King is about a $2 billion a year company in terms of sales. So unsurprisingly, the sales of the combined company go up a lot. But the point really to take from this graph is the change in bookings does not tell us why the share price has gone up. If the share price was related strongly to increase in sales or bookings, we wouldn't be seeing the behavior that we have seen over the last few years. So let's dig a little bit deeper. So piece of evidence number 2. So in this graph here, we have trailing 12-month gross profit figures. So previously we looked at booking, sales, now we're looking at gross profit. I've chose gross profit because it kind of shows more clearly what's happening in terms of profit. There's lots of things that can happen when you boil down to net income, which is the kind of the final profit amount. But we can get a broader view from looking at trailing 12 months gross profit. So again, this is normalized. So taking it from 100 this time back in 2013. So again, we can see looking at Take-Two, the yellow line. So Take-Two kind of rises. So we can see its gross profit doubles in the early stages, 2013-14. Drops down again, and then in more recent years has picked up. But it's still not gone up an enormous amount. So its gross profits have less than doubled over a 5-year period. Again, this doesn't really help us when we're looking at a reason for why the share price has gone up so much. We have a look at EA, the blue line. So we can see here 2013-14 gross profit dropped. And then it kind of picked up very strong in 2015, and then 2017 again very strong. So we can see with EA, its gross profit has gone from a normalized 100 up to 400. So it's increased threefold really, or it's increased fourfold, gone up 300%. So that gives us some idea. That's helpful to see why EA's share price has gone up so much, because it's increased its profits a lot over quite a small period of time. Same thing with Activision Blizzard. So again, its profits actually gross profits go down for 2014, and actually don't come back positive into 2016. Partly, as we've seen before, that's when it buys King. King is a very profitable company. Obviously, it spent $6 billion buying them. But we can see here that kind of the conclusion is, at least for EA and Activision Blizzard, we can see some sort of correlation here why the share price might have gone up a lot, because they've increased their gross bookings considerably over a 5-year period. Take-Two, it has increased booking, it has increased profits, but much harder to see why its share price has shot up so much. So we've got kind of some idea why share price might have gone up, but we haven't really found the cause of why the gross bookings has gone up. So let's go and have a look at another graph. Okay, so for me this graph is the smoking gun of explaining why game company share price has gone up so much over the last couple of years. So this graph here, you can see is a percentage, and it is a percentage of the trailing 12 months bookings that came from digital sales. So we can see back in 2014, none of these companies were making the majority of their money from digital sales. So the majority of their sales were coming from people going into a retailer and buying a game, a physical copy of a game over the counter. You know, typical bricks and mortar retailing. What's happened over the last 4 years, which is the scale of this graph, is we've seen quite a significant transformation from people buying games in stores to people downloading games onto their consoles, onto their PCs, mobile phones. This is not purely a transference of the type of games people buy though. So this is important to point this out. This is not just people, instead of spending $60 in a shop, spending $60 online. The type of games that have become possible for these companies to make have changed as digital has become more important. So obviously you can download a complete game at $60. You can have that transference from physical to digital. But now most games will come with what we might call microtransactions. They might come with subscription models, so season passes perhaps, where you're buying additional content that's just downloaded that you can't really get from a physical model. And so we're kind of seeing this kind of very interesting trend where digital is taking over. So in all the companies now, if we look to 2017, Activision Blizzard, EA, and Take-Two all have over 60% of their bookings. Again, we've done trailing 12 months here, but so all of them have over 60% comes from digital, and that has driven the increase in gross profit. So why is that the case? Well, clearly, when a physical sale is made in a retailer, the retailer takes a margin. So it might be anything up to 50% of the kind of price of that game is taken by the retailer. It's a rough rule of thumb that any kind of transference from a physical bought game to a digitally downloaded game transfers $10 of gross profit from the retailer to the games company. Now, in a case of digital downloads, you still have marketplaces, of course. So we obviously have the PlayStation Store, we have Xbox Store, we have Steam for PC games, we have the Apple App Store and the Google Play Store. So it's not to say that there is no margin taken by the retailer in digital. There still is that margin. Obviously, the App Store is 30%. But even taking this into account, the margin is less than would happen on a physical store basis. So this is why we're getting this transference of $10, roughly $10 of profit to the games companies. So basically, we can look at this graph and look at the rise of digital over the last 4 years, and we can see that's where this kind of gross profit increase is coming from. Now, the kind of perhaps the deeper question, and one I'm not really going to get into at this stage, is does that actually account for the rise in share price? Now, I think it accounts for, to some degree, it does. It accounts for it because we can see that the growth, the sales didn't increase. The companies have become more profitable, and kind of profits, in a sense, are the best driver of share price. So a company can increase its sales, but it might be spending more on marketing, so it might actually be losing profit or not increasing profit. Increasing profit is really valuable in terms of driving market sentiment. I think there are some wider issues, and obviously in terms of the broader macroeconomic picture, shares, pretty much all shares, certainly in 2017, have gone up, and we're basically in a quite strong bull market. So there's overriding market sentiment that is kind of floating all ships, floating all boats, sorry. And in terms of the games industry, there is this kind of trend, this transference from physical to digital, which has kind of, I guess, accelerated it. Obviously, each company has its own reasons, can point to its own reasons for kind of growth, optimism, market sentiment. So for Activision Blizzard, the King deal was very good. It's also had this esports initiative, had the launch of Overwatch, its latest big game from Blizzard. EA has very strong kind of recurring revenues, so these digital subscription models, these microtransactions from FIFA and Madden. It's kind of really two big annual sports franchises that make up now they're its biggest games. Take-Two is the really hard one to argue. I personally see no rationale why Take-Two shares went up 120% last year. It didn't release any games, any specifically or significant new games last year. In fact, it pushed its significant game that was expected to be released last year into 2018. So Red Dead Redemption 2 was pushed into the next financial year. I think In general, though, what we've seen with all these companies is they've posted record quarters. In terms of GAAP, I'm not going to go into all the differences between bookings and GAAP, but there's a reason why these companies' GAAP revenues are increasing more than people expect, more than analysts expect. And certainly on the profit, on the earnings per share, they've been finding it quite easy to beat guidance. I kind of think this graph, which we haven't really spoken about, but we can actually look at in terms of particularly Activision Blizzard here, we can see that for Activision Blizzard, the red line, as happens with EA and Take-Two, the line goes up. So every quarter, it generates more of its bookings from digital game sales. And then suddenly we get to the end of 2016, the start of 2017, and for Activision Blizzard that plateaus. So again, I've broken out Activision Blizzard in red, that strips out the King figures, and then put King in as well. Obviously, King is 100% digital, so the King, including the King figures, the pink line is much higher than the red line, because if you add $2 billion worth of 100% digital revenue, that's going to obviously increase the percentage. But in both cases, it plateaus and then drops down. So obviously, what we're going to see in this trend is, up to a certain point, these companies will increase the digital take of their bookings, but then it will plateau. Obviously, it can't get more than 100%, but what it looks like is much more than getting to 100%. In this case, for Activision Blizzard and King, it's 79% is the point at which it's plateaued and dropped off. So for EA and Take-Two, just over 60%. They don't have this kind of a very big mobile 100% digital part to their business. So the digital nature of their businesses may stop about 70-75% of their business. That may be the peak that they kind of get to in the near term at least. So what I expect to be happening is there'll be a decoupling now. These companies won't be getting this kind of what we might call free money, this easy profit that they were getting just because this digital trend was happening. That was happening to all companies in the industry. Everyone was getting this kind of uplift, this rising tide. That's going to start ebbing away now. So I think for 2018, 2019, in terms of their performance, obviously they have other things that are going on. Other games will be releasing, other initiatives. Esports is perhaps a potentially big one, although debatable. But they'll have their own releases that will drive their own business. But this, just in terms of this kind of passive trend that I think helped everyone over the last certainly 2 or 3 years, that's gonna decline in importance. And I think we're really going to see how well these companies can operate in what is going to be becoming a more zero-sum market. So there will always be growth in the games market, but I think in terms of certainly gaining profit, it's going to be more zero-sum. So if you're going to take $1 million of profit, you're taking that from another company. So I don't think we're going to see this continuing. All these games companies see their share price go up every year. We may see 1 or 2 share price go up, but if that's the case, we're probably going to see the other ones plateau or go down. Anyway, that is it for today. Thank you for watching the video. We like to do these kind of deep dives looking at data for games companies, particularly looking at their financial data. So if that's something you're interested in, don't forget to subscribe to this channel. But thanks for watching, and hope to see you again soon.